Hello there. I am Faizal Rahim with registration number 20P8547 from BA4303, be giving you a talk on series. I hope that you will find this presentation informative and interesting. Now, before we actually start, I will walk you through the overview first and work out the details later on. So, in the overview, we'll go through introduction, what is liquidity and its type, what is the resources of liquidity, then I'll talk about the main topic, what is liquidity risk, then the method and recommendation to mitigate the risk, and lastly is the conclusion. I'll touch upon the introduction part first. Now, financial organizations such as banks play a significant role in channeling funds from surplus units to deficit. During the global financial crisis that started in the US in late 2007, several banks had difficulties due to improper liquidity management. After the occurrences of the GFC, it was emphasized how liquidity is significant to the banking sector because it helps the bank keep track of its financial health and function well. One of the researchers stated that financial institutions that rely extensively on the short-term money market or the market for acquired funds are more likely to experience liquidity issues in the future. Northern Rock is one example. This is one of the famous case studies that suffer liquidity risk as they rely extensively on the short-term money market. Hence, policymakers altered their responsibility to focus more on liquidity and the management of its associated risks within the banking industry because liquidity risk was not previously regarded as a severe issue. In order to fully grasp the concept of liquidity risk, we need to know what exactly liquidity is first. Thus, what is liquidity? Highly liquid assets, which include money in the bank, money market account, certificates of deposit, equities, and loans, can be turned into cash quickly so that banks can pay bills and satisfy other short-term commercial and financial responsibilities. On the other hand, more considerable assets are less liquid or illiquid since they are more challenging to convert into cash quickly. These include automobiles, houses, old paintings, buildings, and antique furniture. A financial organization's liquidity refers to its ability to quickly pay its cash and collateral obligation at a price that is low cost to the institution. That is the broad concept of liquidity. Coming up next is the three significant types of liquidity. 1. Central bank liquidity. 2. Market liquidity. 3. Funding. First, let me briefly discuss what is central bank liquidity. Central bank can provide liquidity to financial system when required, mainly when banks are short of funds. The central bank acts as the lender of last resort, giving credit to solvent institutions when no one else will supply of liquidity to the market to smooth out irregularities in the usual course of business. Next, market liquidity is the capability of trading assets in a short amount of time and at approved price. It is thus measured by the time it takes to bring its price near the market price. A bank is considered illiquid if it is unable to fulfill its commitment on the due date, as this indicates that it does not have the funding liquidity necessary to settle its debt immediately. Despite that, considering the issues that may emerge from liquidity risk, it is always beneficial to examine the sources of liquidity in order to support the enterprise or bank operation and ensure that cash resources are always available. Both the asset and liability accounts of the balance sheet and those kept outside the balance sheet can be considered sources of liquidity. Liabilities represent the bank sources of the fund, while assets represent the bank uses of funds. Sources of liquidity will affect both the supplier and users of the liquidity.
Two assets can be a liquidity source and they are listed under the category Sources of Assets Liquidity. One of them is the illiquid assets, which include cash and marketable securities and are already source of liquidity either through the outright purchase of the securities or the pledge of the securities that are not restricted in exchange for cash. The other assets, referred to as fixed assets, include the plant and equipment, which are considered essential to the income production process in financial institutions such as banks and securities firms. Although it is a potential source of liquidity, selling fixed assets can be highly time consuming, and intangible assets are not considered as possible source of liquidity. The other assets, referred to as fixed assets, include the plant and equipment, which are considered essential to the income production process in financial institutions such as banks and securities firms. Although it is a potential source of liquidity, selling fixed assets can be highly time consuming, and intangible assets are not considered as possible source of liquidity. There are many different liabilities such as short-term financing facilities and medium-term or long-term financing liabilities. The markets for short-term financing such as commercial paper and euro commercial paper as well as short-term card as well as short-term credit readily accessible by banks, accounts payable, deposit and repurchase agreements. These are readily available sources of liquidity, but managing them can be difficult and they can be revoked or terminated. While the medium or long-term funding markets such as long-term bonds, medium-term notes, euro note facilities, and loans were counted as ready sources of liquidity that provide a significant level of funding stability, the short-term funding markets. Off-balance sheets are transactions that are not included in a corporation apparent assets or liability. These transactions, which include securitization, contingent financing, leasing, and derivatives, are examples of off-balance sheet transactions that have an undetermined value. To begin, securitization is an acceptable source of liquidity. Secondly, contingency financing is an excellent source of liquidity that can be tapped into it if the situation requires it. Thirdly, leases are valuable sources of liquidity, allowing funds to be used to satisfy other obligations. Last but not least, derivatives provide a source of restricted liquidity.
In general terms, liquidity risk happens when a bank cannot handle a drop in its liability or pay for an increase in its asset. When a bank lacks liquidity, it cannot get enough money by taking on more debt, selling assets and cheap, which hurts its ability to make money. Liquidity risk occurs when there is a chance that an institution's financial health or stability deteriorate as a result of its failure to meet its commitment time. One form of liquidity risk is central bank liquidity risk. This risk is considered almost discounted to zero, since the central bank controls the liquidity supply and may distribute it whenever and whatever is needed. Now, next, market liquidity risk occurs when the market lacks the capacity to process transactions, also known as the marketability. It is also related to bank assets because it is difficult to cover any risk associated with them since it will cause the market price of the asset to rise. Let me give you an example. Selling or liquidating a branded car for 4,500 take quite some time, isn't it? This is due to the market's inability to handle this transaction as no buyer is interested in purchasing the car. As a result, the car owners hold onto the asset for an extended time, forcing them to sell the car at a reduced price, which is mean the car will be sold on the discounted price. When this occurs, the automobile owner will not receive the expected profit if the car is sold at a discounted price, the profit obtained by selling at the original price. Bitcoin and cryptocurrency are two other examples of market liquidity risk. The market liquidity risk arises due to inadequate market depth, market disruption, or the bank inability to access market are all potential causes of liquidity issues which is connected to the bank solvency. Next up, the liability side of a bank is the only part that has anything to do with funding liquidity risk, where a bank cannot get enough money to pay back its debt. In this way, funding risk is the chance that the cost of funding up. Hence, the causes of liquidity that can be taken from funding liquidity risk are the gap in maturity between asset and liability sides of the balance sheet is regarded as the cause is regarded as the root cause of the increase in liquidity. This discrepancy originates from two possible situations. One of it there is One of it is there is an abundance of liquid asset that can be invested or a lack of such assets that is necessitates additional liquidity. Moreover, the other situation is that when a financial institution has too much cash, moreover, the other institution that when a financial institution has too much cash, it might miss out on a lucrative business prospect. At the same time, when it has too little, it runs the danger of customers pulling their money out. There is a relationship between funding liquidity risk and market liquidity risk, even though the definition of each liquidity risk have different meanings. This is because when cash outflow exceeds cash on hand, corporation or bank is forced to sell part of its asset to generate cash. Now, financial ratio analysis is a reliable method for assessing the dangers of insufficient funds. As you can see here, I have listed out the financial ratio analysis, which is the EBIT, the quick ratio, and the current ratio. First, operating cash flow indicators are one of the things that need to be looked at. The ratio of earnings before interest and taxes, which is EBIT, is shown as a multiple of interest expense, can be used to figure out how likely it is that a company will be able to pay its debt on time in the short term. Improvements to working capital can be pinpointed with the help of a solid cash flow forecast and the application of financial management ratios. The ratio used in the working capital include days debtor, days creditors, days stock, and days work in progress, which applies to certain businesses only. Some ratios helpful in assessing liquidity include the quick ratio, indicative of the amount of cash cushions and the degree to which current liabilities can be settled instead from cash and short-term investment. Lastly but not least, the current ratio measures the ratio between the book value of a current asset and current liability. The standard comfortable ratio is more significant than 1 to 1. If the ratio is less than 1 to 1, there may be a cash deficit that must be addressed. Next up, there are three strategies. There are three strategies to improve commercial banks. Increase access to capital, properly handle bad debts, improve credit quality, and improve internal bank liquidity management laws. Excessive reliance on a few capital sources will increase liquidity risk instead. As a result, banks must diversify their funding sources, particularly funds from international financial institutions, in order to mitigate the detrimental impact of domestic market swing. Implementing the recommended measures for dealing with bad debt is the second tactic. The banks are required to aggressively collaborate with their customers to restructure debt, lengthen payback periods, and cut interest rates in order to stimulate customer repayments so that even if they face temporary financial difficulties, they will be able to pay creditors after regaining control of their business. When it comes to bad debt, banks need quickly to liquidate all guarantee assets in order to recoup money. The third strategy is where commercial banks should assess their financial condition and then proactively develop and implement strategies for managing the overall risk and the more immediate liquidity risk they face. In conclusion, to properly understand the liquidity risk, it is essential first to understand the terms liquidity types, and liquidity resources to comprehend what causes the liquidity risk, how it can be measured, and what measures are taken to mitigate this risk. The ability of an institution to satisfy anticipated and unplanned cash flow and collateral requirements without affecting day-to-day operation or financial situation is crucial to maintaining appropriate liquidity. These three critical liquidity types and risks include central bank, market, and alternative funding sources, and there is a link between these three types, even though the definitions are different. That's all for me. Thank you for listening.